Hey everybody, welcome back to the channel. I'm Doug, the retirement guy, and today we're talking about the top growth ETFs of 2026. Now, what we're going to break down here is a lot of information about our growth bucket of our three bucket portfolio. Because we spend a lot of time talking about income, we talk a lot of time about foundation, but we don't spend a lot of time about the top growth ETFs. And I'm going to show you what I think works out the best in this portion of the ETF. But before we get farther, I got to say a thank you to all of our new subscribers and all of our past subscribers. Thank you for coming back and keeping the channel afloat, and also our Patreon supporters. I also got to put a little dig out there and say, hey guys, what do you think of the mug? The retirement made easy. Come drink up those dividends. I'll tell you what, I put this out. I made a notice that we're offering this cup out there. And I cannot believe how many of you have jumped on and already have ordered the cup. Thank you so much. If you want to get that mug, we got them. We just ordered our second batch already. We got our second batch in, so we can get you a nice hot mug. You guys really help support the channel with just buying a mug. Go to our Patreon. It's free to join. You'll see where the mug is at. Go ahead, click on it. Order yourself a new mug. So the three bucket portfolio, the retirement portfolio that we talk about, bucket number one is always that foundation bucket. You know, this is where the money, you're just basically going to put the money there. It's going to sit, slowly grow. The bucket number two is one that we put our big growth into. We want to make sure that this thing's making up for inflation. It also helps grow the fund so we can put more money into the bucket three, the income bucket. So the whole idea of this one is like I call it the fertilizer of the plan, is that grow your internals. And then of course bucket three is our income, which is the dividends that we're living off of and that we're going to continue to take the money out of on a regular basis. Now, why is growth so much matter in these ETFs? Well, long-term wealth creation is from disciplined and patient investors. The growth is designed to be outperform value. It gives some wealth generation. I always try to look for things about a 10-year horizon, which is best suited for that patient, long-term investor. And we really watch for those corrections and opportunities. I'm not looking to sell these funds. What I'm really looking to do is when we have a nice correction, we take additional funds, we pour it into to help grow the fund even more. No matter what we do, we're always looking to try to grow our particular fund. Growth investing rewards patience, not market timing. This is a big one that people always think about, is they start thinking they're going to try to time the market. And the answer is no, just be patient, buy consistently, buy accordingly, and move forward. And like I said, the biggest mistake that investors make is they do panic sell-offs. They see the market's going, they want to capture as much of the income they get, they sell off. They don't wait. And what happens is they miss the whole big recovery. This is why I always tell everybody, I said, when we have issues coming on and we have big drop-offs, I always say stocks went on sale. Things are always kind of like, hey, you know, are we at bottom? Are we gone majorly down? How is this going to help grow me down the road? And I've done this numerous times. We've done it in the dot-com boom. We've done it in the financial crisis in 2008. The COVID deal was a huge, honestly, a moneymaker for myself. And then we had the bear market of 2022. So this whole thing is just having that patience, having some extra money on the sidelines to be able to invest when things drop off. So here's the thing I always use. This is my checklist, the growth ETF evaluation criteria. I want to make sure the fund that we invest into has assets under management. I talked earlier about a different video that we talked about having $100 million plus as an assets under management. That is a safety and secure piece. Well, that's one thing I always will look at. I will look at the expense ratio, cost efficiency over time, because we're going to be holding these for long periods of time. I want to look at the technology sector right now. Technology has been huge in the past 5 years. Technology has just been exploding. Okay, so you want to make sure you got some technology into this. You want to look at the number of holdings. So you want to be diversified. You don't want just all, NVIDIA. You don't want all just Google. You want to be a total number that just gives you a big diversity. And then, you want to concentrate your risk, your top holding weight impact. So you want to look to make sure you're not duplicating. You want to make sure you concentrate your risk so that you're spread out, again, with diversification across the board. And then I always want to make sure I'm looking at the historical total returns. Remember, I'm a total return person that tells you more about the fund than anything else. So I want historical total returns. If I can get 20 years out, 10 years out, those are beautiful numbers to tell me, because there's so much in history has happened that we can tell what's going to happen to the fund. Past performance does not guarantee future results. I always say that. But at the same time, if you look at something that's been there for 10 years, 20 years, you pretty get a good feel of what's going on. Now, the most popular growth funds that are out there, this is kind of always called the top 9, and for the total return crown. Well, QQQ from Invesco is always strong there with the NASDAQ 100. The Charles Schwab funds have always been strong. The iShares Technology, and you'll see here, the Vanguard Technology. Those two have really been running strong. The Vanguard Growth Fund, UVG. Another tech, spider, the technology sector. So you can see where we show the 3 major techs, plus we have semiconductors, we have some broad growth funds, a momentum fund with the S&P 500, and then again, the QTM is really more of a NASDAQ and quantum computing side of things. So it really comes into an innovation. I call it the innovation fund. So these are 9 very, very popular funds. Now, I'm not going to break down all 9 of these. I'm just going to show you what actually I use in my portfolio to give you a good idea of what I do. But I wanted to show you these 9 are the most popular funds that are out there for you to do some research, give you, cut through the chase and say these 9, take a look at these funds and see if these wouldn't work in your growth foundation. So here's my portfolio. Here's my example that I use. I put 15% of my portfolio into my growth sector. Okay, I don't put it all because I'm living off of dividends. So I am putting 75% of my funds into income, 10% into the foundation, 15% into this portfolio. Now 40% of it's going into VOO, an S&P 500 fund. I'm very secure with S&P 500. I love S&P 500. I take the Warren Buffett answer. He tells the 20-year-olds, the 30-year-olds, you're going to do anything, put your money into the S&P 500, like the VOO, let it sit, let it run, go. I'll cover each one of these in a little bit here. Our next one, VGT. This is my technology leader, okay? This is my big tech tribe. And this is one I get excited about, I get motivated with. It's not my biggest portfolio portion of it, but it's one that performs, that probably outworks everything else. Now I do a QQQM, not the QQQ. I do the QQQM because I just like the way they design their fund. It is my NASDAQ 100, so you can see I have S&P 500, the NASDAQ 100. I have a sector that I just selected was technology because of what it's done. And then our final fund was, and I know a lot of people argue with me on this one, I actually put my SCHD into my growth portfolio. And I have it at 10%. So I'm not huge onto it, but it's definitely a reason why I put this in there, and I'll explain exactly why each one of these fits and what I do. So that gives you 4 ETFs in my growth bucket, 40, 30, 20, and 10, all working together to give me a strong, strong growth future. So let's take a look at the Vanguard S&P 500. Now, as we said, all the checklists I tell you, assets, $1.03 trillion of money is in the VOO from Vanguard. Okay, expense ratio, 0.03%, almost literally free. Okay, it does pay a dividend of 1.04, but I'm not looking for dividend from this. I'm looking for point blank, all out growth. When we take a look at the performance, okay, performance. This one gives me my calendar that I've asked you for. First off, 1 month, it's up 1.28. Year to date, up 10.08%. Year on year, 26.76%. So remember, if you take 1 percentage point off of these, that's your dividend. Everything else is all about growth. Okay? 5 years, the average is 13.75. 10 years average, 15.62. Since inception, which is 16 years now, 14.89%. So if you take this fund and say, I have a yearly growth of about 14%, I wouldn't be lying to you. That's my average across the board, almost 15% total. That every dollar I put into that is going to grow by about 15 percentage points. This is why it's so critical having this into it. Now, and you ask, why do I worry about this? Well, because the more my bucket grows, my portfolio bucket of growth gets bigger and bigger, I can take money off of that, put it into my income fund. But I always have my bucket at 15% of my portfolio. Okay, so the bigger this thing grows, the more I can put into my income fund, which means I'm going to have more income down the road. Now, the Vanguard Informational Technology ETF, VGT. This is what I call my big technology play. Now, this one's $142 billion, so I'm not playing with small funds. This one has a 0.09% expense ratio. Again, almost literally free. It has a dividend of about 0.32. Again, I'm not worried about yields. I'm not worried about dividends out of this. I'm worried about growth. Now, this fund is actually technically a little bit older. It's 22 years old. Okay, so when we take a look at this one, 5.94% growth in 1 month. Year to date so far, 27.53%. I say the dividend yield for a reason. If you take that 0.32% off of any one of these, you will see how much growth technically you're talking about. Okay, 1 year, 53.29%. 50% gain in one year. Now we take the 5-year average, 20%, 20.73. The 10-year average, 25.65%. Since inception, 15.22. Now you say VOO was, almost 15%. This one's 15, so they're about the same, right? But you got to remember, this thing is 22 years old, and technology, it wasn't as strong as it was today back 22 years ago. So technology is massively changing here. That's why the 10, the 5, and the 1 are such bigger numbers across the board. Now we go to Invesco NASDAQ 100 ETF QQQM. I told you this. I like this because expense ratio only 0.15, $96 billion in investments. This fund again has been out only 6 years, has a dividend about 0.42%. But when we start looking at this, look at what QQM has done in 1 year. I put that on the board immediately, 40.55%. The technology side of the NASDAQ 100 has grown, but these guys have been able to manipulate the funds properly to get even more growth out of it. Now, being 6 years old, we got a 5-year track record. This one would be perfect if I could get that 10-year mark into it, but unfortunately, we got to wait a few more years. So doing this one, 4.33% in 1 month, 20.57 year to date, 40.55 in 1 year, 17.24 on a 5-year average, and 18.36 since inception. So it just shows that the NASDAQ 100 with the total technology into it, what's going on with it, I just think this is the better play across the board. Again, trying to build our bucket to overflow, and that overflow goes in income. Now this one here, I know you guys will probably say a lot of different questions. A lot of different people will say things. How could you put Charles Schwab's U.S. dividend equity into a growth fund? Well, if you guys have paid attention to this whole video, I'll tell you, it's $95 billion in assets. So I don't have a single fund in here that I even worry about the liquidity of it. Next, I don't even have a fund in here that I worry about because none of the funds pay more than this one's the highest, 0.06% expense ratios. Now, the 3.3% yield is actually misleading, and I'll explain to you this. it's 3.3% over the past 12 months at today's price. But this fund grows so much that your yield actually, I've looked at my true numbers, were actually almost 8% dividend yields because of what I bought and how I bought it. Now, this fund came out 15 years ago, okay, in 2011. The unique thing with this one, look at the pricing. The pricing really runs between $31 and $32. Okay, weekly high, 52-week high is $52.92. Okay, so this fund really, and they make a changes about every March. They rebalance, they readjust the thing, and it took some hits earlier. And that's why you'll see the 5-year mark, past 5 years, it had a little hit, didn't match properly. Well, this thing turned around and it's gone strong. So in 1 month, it's up 0.44. Year to date, 17.13%. 1 year, 23.83%. That 5-year, 8.69 average, again, like I told you, they missed the mark and they took a hit for it. But over 10 years, 10.57, and since inception, 13%. So it just shows you, again, another strong fund developing good returns, good growth. Again, we're not worried about yield. We're worried about growth. And it gives us a growth fund that we're talking about. So when you take a look at the portfolio allocations, the performance, the core funds, and then we have that blended Charles Schwab one. So here we go. VOO, the S&P 500, I put 40% into that, gives me a 26.76% total return. We look at the yields. I only put the yields out there so you can see that we're having a good, solid 25% growth in the fund. Now we go after technology, okay? And this is the fund that I know it could possibly drop off. We could have some changes, but we're going aggressively after technology, 30%, and of that, 53%. QQQM is my NASDAQ 100 mix. You know, there's a lot of different funds. I showed you 2 earlier. This is another one, 20% into it. So you can see how I just heavily into S&P 500 because I trust it so much. It's not I'm not putting everything in the biggest total return. I'm putting it consistency that I know works. Then we get into QQQM, 20%, 40% total return there. And then the Charles Schwab, 10%. Because I really didn't trust Charles Schwab at the time because because they didn't have the changes. And when they made the changes, I'm like, okay, now you guys are back in the realm of things. You're getting back in line. 23% total return. I take that 3.3% and do 2 things with it. One, I'll drip it back into the fund and buy more shares of it. Now, if my income starts to hiccup a little bit, I have a 3%. And realistically, because I've owned it for so long, I actually have an 8% yield coming to me. It helps my income. It's like a barrier I put in there for my income side of it in case something happens. Plus, that 3% helps keep the fund rolling above inflation. Another big factor. That's why I keep telling you, it's early 8%. It's getting it into early, stay into it, let it run. So grand total return of my fund is 37%. Okay. So when I take my fund, I'm just going to use basic numbers. If I want $10,000 in this fund and I'm gaining $3,700, that means I can take that 37% growth. Okay. And I could take that money and take that $3,700 and roll that next year into my income bucket. And my fund will still say $10,000 in my growth. So it's like planting a seed and just trimming off the branches and put it over the income fund. This thing helps continue keep my fund growing. Same thing that happens in my foundation fund. So this gives you a blend of how I build that part of the portfolio. Now, the best ETF by investor type, right now, the tech bull, that VGT, is just dominating the marketplace. It does very, very well. But I also want to tell you, I get a complete blend across the board of all 3 of these funds. Now, the growth investor, that QQQ or QQQM, is that NASDAQ 100 that has that technology part of it, but so much more. It's the largest 100 companies out there. And it has that proven long-term performance. I'm going to drop down the VOO, the S&P 500 Foundation. This is a broad market exposure with the time-tested reliability. It's my core, my portfolio. That's why it's 40% of what I deal with. That's really a set it and forget it. Let it grow, trim it off, let it grow. And then our final one is that broad growth investor with the dividends of the Charles Schwab, SCHD. It just does a great job across the board in giving me insurance across everything I asked for. So the final takeaway, guys, the principles that separate long-term winners from the rest is growth creates wealth. Okay, my growth has continued to every year. I get bigger and bigger funds, even in the down years. Even when my income was dropped down, we had some drop-offs. My growth bucket is always continually refunding, rebuilding my income fund, and like I said, for 10 years I've been able to live on it, and my money just keeps growing, growing. Stay invested through every cycle. This is why I never get rid of my growth fund. I never get rid of my foundation funds. I may change some things, but I don't ever just totally get out of it. I never panic sell. I'm focused on decades, not months. And that consistency beats the market timing at all times. So let me know what you guys think about this. Let me know what you thought. Hopefully I've given you enough information on the growth funds to help you build out your second bucket of growth. Let me know what you think. Give a comment down below. And remember, don't be afraid to go to that Patreon and secure one of our new coffee mugs.
Thank you for watching.